This is the Savvy Investor Podcast. Welcome, everybody, to another episode of the Savvy Investor Podcast. I always have this amazing guest, Mr. Kyle Green from the Green Mortgage team, because you know what? He's got all the money. That's the guy, right? That's the guy we want. We want to talk about. We want to take care of this gentleman because he's got all the money, or at least he has access to the money, right? So this is one episode that you absolutely want to listen to the very end because he provides just so much wealth of knowledge. So before we jump into today's episode, I'd like to highlight this episode's sponsor. This episode is brought to you by our Savvy Investor trusted partner, the Phipps Real Estate Group. Have you been thinking about investing in the Calgary real estate market, but just lacking the right team to guide you? Then look no further than the Phipps Real Estate Group, led by Natasha Phipps and Andrea Tessier. They're more than just realtors. They're investors themselves, which means they understand the opportunities, risks, and more importantly, what makes a good real estate investment work. Whether you're looking for a single family or multifamily property, commercial property, or land development opportunity, their team takes a hands-on, personalized approach to help you reach your goals. At Phipps Real Estate Group, they know that every investor is different. That's why they take the time to understand your needs, create a strategy that works for you, and find the right properties to fit your investment plan. If you're ready to work with a team that puts your goals first, visit phippsgroup.ca to set up a discovery call, or you can visit the show notes below for the link. Kyle, thanks for being here. Really appreciate you jumping on the podcast yet again.
Yeah, of course. Happy to be here.
Very, very good. So, today we're going to kind of take it in a little bit of a different direction. And, it's kind of the new year and people are just getting started. People are anxious. They're excited because it's a brand spanking new year. Their goals have all been written down. Again, they're going to be losing weight. They're going to be making a lot more money. They're going to be doing all of those things. And for a lot of individuals, they're looking at, hey, as part of their goals, I'm going to be buying my first multi. I'm going to be buying another single family home. And for some others, they're going to be just like, you know what? I want to buy my first investment property. And so one of the key things and one of the most important things is obviously getting access to capital. So I thought today's discussion is really about that. It's literally about, for those that are just beginning, how do we begin with just getting your financing approved? And at the same time, for those of you that have actually started to scale your business, how do I continue to get the banks to say yes to me? Because at some point in time, the banks will say no. So maybe just before we begin, Kyle, maybe do a quick introduction, a little overview. We've had you on the podcast before, but for those that maybe are listening to this for the first time, maybe you can just give yourself a little introduction.
Yeah, sure. I've been a broker for 19 years. So as of November 2025, it's been 19 years. So I'm 38, and half of my life, my entire adult life has been talking mortgages and almost all of that. So I started in November of 2006. In early 2008 is when I started working primarily with real estate investors. It became a very large percentage of my book of business. So I've been focusing on that specific niche for a very long time. So we help investors build their real estate portfolios, give them advice and input, show them how to maximize the returns on investments. A lot of the other conversations that come up are, should I incorporate or not? And of course, we're not accountants, or lawyers, but we tend to know a lot about those tertiary items too that are important when making decisions. And of course, financing experts, finding the best rates, the best products, the most money, and trying to make sure that all works together on one cohesive plan.
Yeah, that's one thing I love about Kyle is regardless. Kyle's got so much experience, 19 years of this, working with investors. So he understands the mindset of investors and what they're focusing on. Because for a lot of, and I'm not trying to knock other mortgage brokers or bankers and stuff, but they just may not have that experience when it comes to dealing with investors, because sometimes we're a pain in the butt, to be honest, right? And I know I am, but truthfully, it can be a real pain in the butt. And so, but what their job is to kind of provide a kind of great roadmap of how many properties you're trying to grow. And something we've shared on this podcast several times is when you're working with a team member, make sure that person's got experience. And Kyle's one of those people, not just personally, but he's been working with investors for a very, very long time, which is why we have such confidence in bringing him on this podcast, of course. Let's kind of take a step back here. And so let's talk about just the financing world right now. And I said I wasn't going to talk about it, but I'm going to bring it up a little bit. And what's happening right now in the financing world? I know that we've been dealing with lots of just turbulence and tariffs and all sorts of stuff. Are the banks feeling a little queasy about things? And what's kind of your overall feel of how the banks are operating and feeling in regards to investors?
Yeah, there have been minor changes, nothing major. Many investors may have heard about something that came up a little while ago, and it freaked a lot of people out. But there was a conversation about the dual counting of rental income. You may have heard about the
Did hear
office
about that. Yes.
and
Yeah.
wanting to bring that up, and so initially there's a very large concern of like, oh my gosh, they're not going to include rental income in the calculations, and I won't qualify for mortgages, and that's not not correct. But it's one of those things that still will have an impact on the back end for the bank. So long story short, the government is effectively making it more expensive to book rental mortgages and keep those on the books. And
Mm.
so they're effectively looking at things from a bank's portfolio perspective, and how many of your mortgages are in a position that exceed certain criteria or certain ratios. And for each of those mortgages that exceed these ratios, they need more capital sitting on the books that makes them no money. So every
Mm.
mortgage that goes out the door, they have to have some capital reserves, and those
Yep.
capital reserves increased after the subprime crisis of 2008 because banks had very minimal capital reserves, and we saw banks in the U.S. go under, and some banks in Canada also went under, although it wasn't nearly the same level. Generally speaking, the government has continued to make it more expensive to fund mortgages over the past 10 years or 15 years, and now they're having a micro moment looking at rental properties. So not a
Mm.
major concern, but what we do see is that lenders are constantly rebalancing their portfolio in the back end. And what we often have seen in the past is all of a sudden the lender will say, now we have a really high a premium on the rate for rental properties. And
Right.
that's we need to stop getting so many rental mortgages in the door. Or sometimes they'll change their rental policies and just dial them back a little bit to say, okay, we need a little less. But
Mm.
often that is cyclical too, because eventually they say, you know what, we have a bit more appetite for it. Let's ramp it up now, and maybe we'll drop the rate premium, or instead we'll modify the way that we're going to underwrite it. Maybe we'll bump it up a little bit. So there is a bit of a tug and pull on that. However, historically, it's gotten harder and harder and harder as an investor.
Yeah.
Even though we have these cycles, it tends to get a little bit tighter. Where I have seen a large change is more on the commercial banking side, and that's mostly as it pertains to operating businesses. I have heard a lot of stories in the last 6 to 12 months about people getting debanked, or lenders pulling credit facilities or restructuring businesses. And so we're finding a lot more in the business loans, especially with operating companies, that's been tighter. But it
Interesting.
also has tightened up a little bit on the commercial lending side a little bit. We've seen CMHC tighten up on some of their policies. So I would probably say that the part that's been impacted the most is definitely on the commercial banking side for operating businesses. That's a big change. And it does then pertain to how they will underwrite a mortgage for somebody trying to buy a location for their business. And then we're starting to see some smaller changes and just general tightening on both residential and commercial investment lending.
Yeah. Are you seeing the same issue in the commercial multifamily side? Are they lumped in together with the commercial side?
A little bit, yeah. We've had a couple of lenders say that it has been tightened. I did hear from one source just a couple of days ago, however, that it seems like there's going to be a slight relaxation in the
Mm.
near future on that, especially when they look at the development side of the portfolio. And
Mm.
so I think that what's happening is if you're a developer, a lot of those developers, their bank or credit union eventually was saying either no, or they just moved the goalpost to such extremes that it was basically a no.
Yeah.
And it got really hard to fund land in particular, especially if you
Mm.
didn't have a building permit. So that got really tight. Then all the money flooded to private lending, which is of course more expensive. And then all the private lenders said, well, we have too much. And by the way, that's also where all of our losses are. It's all in the
Yeah.
land portfolio. So they're tightening up and they're pulling off. So any land or development was getting really tough. But now the government is also looking at this as a concern for the cycle if you project a few years into the future. If land financing is too difficult, and therefore development financing is too difficult, then we're going to have a shortage of real estate in the next few years, which will then again put upward pressure on valuations. So the government also doesn't want to have this cycle where all of a sudden in 3 years from now, nothing is being complete because nothing started today, and all of a sudden now we have a shortage of supply, and now prices skyrocket. So there's so much that goes on in the really high level ivory tower bank financing behind the scenes, and a lot of it is like little nudges on the portfolio, but we're talking billions of dollars getting thrown around into different buckets.
And I think this is important for everybody to listen to that. And Kyle, you can answer this question. It's just like the rules are changing constantly. Like, and that's the thing, is you need to have a very good relationship with your mortgage broker, period. It just, like I said, there's all these ebbs and flows and things and changes and risks and all this stuff. Make sure you have a good relationship, because you guys got your fingers on the pulse constantly on all of this stuff. And, you've done an amazing job just sharing a lot of your knowledge, not only to our savvy investor community, but obviously in your own business as well, about some of those changes, to making sure everybody's quite informed, because some of the rules that have happened 6 months ago completely have changed, 6 months later. And you're just like, wait a minute, but that was just happened 6 months ago. I know, but that's the game. And maybe you could just highlight that, right? Am I correct in saying that constant changes in the financing side?
All the time. Yeah.
So let's talk a little bit about, here we are, 2026. And so, I think for a lot of people that are maybe getting started in real estate investing, it's kind of a scary time. And I'm sure you have had those discussions with investors in the past. I know I have, where do I begin? How do I get started? Wait a minute, I got to use a line of credit, or should I use my line of credit because they read that in a book or watched it through a podcast or something like that? So maybe we could just kind of talk a little bit about that. And this is kind of really relatable to our new investors that are beginning, and somebody that's just absolutely new, and they may have a home and they may have equity. But how have you found most investors get started when it comes to buying their first investment property?
Yep. The first step, no matter what you're doing, is always access to capital. And so, depending on what your current situation is, that can be very different. As an example, somebody that has a home that's fully paid off, that's a great spot to look at targeting. Getting a line of credit set up against that to utilize to invest is one of the an obvious choice. Even if it's not paid off, you can finance up to 80% of the property value. And so, if your home is worth $1 million and you owe 300, then you can bring it up from 300 to 800, which means you have an extra $500,000 available capital. And here's the crazy thing: is if you had that $500,000 but 20% down on real estate, you basically turn 500 grand into $2 million worth of real estate. So, in theory, much easier to do than in practice. Qualifying for that much debt would be difficult for many investors, most investors, I would say. But long story short, there's often ways, especially if you've owned a home for quite some time. But the strategies are different. Some people have a lot of cash that's sitting in GICs, and they're like, I just don't really want to be sitting on GICs. I want to invest it and get a higher rate of return. Generally speaking, you want to figure out where is the capital coming from, and this is where myself or somebody on my team can better identify where the sources of capital may be best, because there's different things to look at. Number one, there's something called the Smith maneuver. It's really important to know, which is that anytime you borrow money to invest with the expectation of generating the income, the interest cost is tax deductible. So sometimes what people do is they have their mortgage and they have a line of credit or maybe no line of credit. We often will go in and restructure things, and we might say, hey, you know what, if you liquidated all of these other assets, paid down the non-tax deductible mortgage portion, and then now we're going to reborrow that money back out that you paid down on a line of credit or another mortgage portion, and use that for the investments. You can even put them right back into the same investments you already had. There's some tax consequences. Some of these, there's capital gains if you're selling stocks and things like that. But generally speaking, the long-term benefit is now you get to write off the interest on all that borrowed money that you use to invest. So right. I always have to preface the tax stuff and say you have to make sure you run this by your accountant, but it works in almost every circumstance except when you're investing the money back into something that's tax sheltered, like a TFSA or RSP. They want you double dipping on the tax benefit when you're doing it that way. But that's often the first thing, is restructuring the residence, to maximize the amount of equity, maximize tax deductions. And then the third thing we're usually doing is maximizing borrowing power. And how we do that is we usually re-amortize your debt. Don't be shocked, over 30 years. Some of you might be paying off your mortgage and you're like, I only got 3 years left or 5 years left. That's wonderful. But when you have a very high payment as a function of how much you're borrowing, that means you have less borrowing power to go out and buy other properties. And it's very difficult because generally speaking, the lenders only use 50 to 80% of the rental income on each of the properties that you're acquiring. And that can make it really difficult because every property, especially if you're maximizing the leverage on it, is going to likely be a net negative on the application, not a net positive. You've got to have enough of a surplus of income or for debt servicing to be able to acquire a number of properties if that's part of your plan. So re-amortize the debt over 30 years, pay off and consolidate all of the debt because the mortgage will have the lowest payment versus everything else. A car loan is a 5 or 7 year loan. A mortgage is a 30-year loan. And often the rates of a mortgage are lower than most other things that you would be borrowing money for. So restructure everything, throw that all into the mortgage, reduce the payment as much as possible by re-amortizing it. And here's the thing, especially if it's your personal mortgage and you don't want to pay it over 30 years, which I totally get, the lump sum prepayment privileges are usually way more than you even have access to. Like most lenders allow you to pay off 15 or even up to 20% of the mortgage per year with no penalties. I mean, you can pay it off in 5 or 7 years just by maxing that out, which most people aren't even on a 5 or 7 year amortization anyways. So you still pay it off faster than you expect or want.
Yeah, very good. Lots to unpack there. Lots. And I guess maybe we start off with, just to begin with, okay, we've talked Smith Maneuver. There's been a great episode. We actually had Robinson actually join us to talk about Smith Maneuver. Check out that podcast as well. Really great. And it's one of those strategies everybody should understand and know, especially when you're first getting started, because you do kind of want to get a lot of that stuff set up right at the very, very beginning. So obviously talk to Kyle if that's something that you're looking to dig into as well. But you just referenced this is like, there's specific ratios and things that the banks are going to be looking for. And you referenced the term debt service ratio. For somebody that doesn't know what that means, what are some of the measurements the banks are looking for and something that we should be even more mindful with? You know, the one number a lot of people are aware that's going to be done is, you know, obviously your credit score. Is there a specific credit score? You know, how impactful is that on the mortgage? If you don't have great credit, but it's in the debt service ratio. So maybe give us a little bit of insight about what are some of those triggers or numbers that we need to kind of stay within, or just to better understand it for those that are just beginning?
Yeah. So the method and the formula that the lenders use is they want a certain percentage of your gross income to be used towards all of your debts. They call it the debt service ratio. And they usually want that ratio to be about 44% or less. So
44.
that means make $100,000 a year gross before taxes. They wouldn't want more than $44,000 a year going towards all of your debts. Now, that formula can be a little bit more complicated because, okay, well, how much rental income is being factored in for different properties, et cetera. And so that can be challenging. Also, if you're self-employed, there's different programs that can enhance the income that we can use, which I won't talk about today, but just know that there are programs, especially if you're self-employed, that can boost the income usable, because that's often the challenge. People write off their income, and then that number's too low to qualify. But in general, the math is, if you're just looking at how much you qualify for on your residence and you have no other debts, every $20,000 or $25,000 of income qualifies you for about $100,000 in a mortgage. So if you're looking at that, and the other way of looking at it is it's about 4 to 5 times your income. You can just multiply your income by 4 or 5 times, and that's the maximum loan amount you can get. That gives you a rough idea of your borrowing power on your residence. When it comes to rentals, it gets a bit more complicated. But here's the one thing is, if your residence is already over that number, if you make $100,000 a year and your mortgage is at $800,000 as an example, that's more than 4 or 5 times your income. You're probably not going to qualify for any rental property at all because of that gap and that negative amount. There are more complex methodologies if you get into commercial lending, then that's based more on the property itself and not based on your personal debt servicing. But even then, they still kind of look at that and say, well, we know that the property's covering itself, but what about you? We're worried that you're going to take the rents from the rental and then skip out on the mortgage payments on the investment, right? So they still like to see that your personal residence and personal debts are still in line with that debt service ratio.
Yeah, awesome. That's really, really good. There were lots there too, to be honest. And so again, just be very mindful of all of those things. And I think the other part is obviously you need to obviously understand a lot of your expenses as well. And I think one of the ways that everybody should be paying attention to is also the qualification side. Is okay, how many mortgages do you have? And if you're looking to get an invest in a bunch of investment properties, just understand this debt service ratio. Really, really key. So if you're about to finance a new investment property, don't go and buy a boat or that you are about to finance or a brand new car at exactly the same time. And I think the other part that you should also communicate is tell your broker everything. They are there to support you. And I'm sure you've had that situation once or twice in your life, Kyle. I'm not sure if that's
Once or
happened.
twice, yeah. 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 Funny story. When I bought my first place, and I wrote the offer when I was 19, and I think I closed when I was 20. So I guess I was 20 years old. But I closed on my first place. Now this is interesting. Back in the day in 2007, you could do
Yeah.
zero down, 40-year amortization, and so that's what I did, of
Nice.
course, so I can get into the real estate market as a young kid. But the key was because I was maxing out my debt servicing, I maxed it out and borrowed like the highest amount I could possibly qualify for in the mortgage.
Yeah.
And then I went off and then I bought a new car and I still qualify for a car loan. So it's really important to do it in the right order too. Like you might need a car and that's fine, but make sure that you do it in the right order because in general it's easier to get car loans and other loans like that because they're
Mhm.
smaller, they have a shorter amortization, they're paid off faster.
Yeah.
It's much easier to do it in the opposite order. So just make sure that you do the important stuff like the appreciating assets first, and then if you really need the depreciating asset, then go for it, I guess.
Yeah, very good. I hope everybody listen to that because that was that was a big carrot that was there that was given to you. So it's really good. So when it comes to financing, especially from investment properties, is there some debt or something that really that hurts investors? Like, is it credit card debt? Is there something specific that we should all be very mindful of when we're trying to get approved? Like, I know we just talked about a car payment or a car loan. I don't know if that has a bigger impact in regards to approvals or not, but maybe you just can provide us some kind of ideas of what should we be mindful of just if we're trying to go down this road to buy as many properties that we have. um, there's probably some things that we need to put into check just before we do some of those things.
Yeah. So normally this is where again step one, restructuring if you have your own home, restructuring the residence, paying off basically all debts, rolling it all into the mortgage, consolidating, and then re-amortizing is like always step number one. And I'll give you an example. Lenders use 3% of the outstanding balance for any unsecured debts, credit cards,
Mm.
lines of credit, that kind of thing. So to put in perspective, if you have a line of credit with about 15 grand owing on it, an unsecured line of credit or credit card or anything like that, they will use a payment of about $450 per month on that. That's about
Mm.
the same as borrowing 100 grand on a mortgage.
Wow.
15 grand versus 100.
Yeah.
So when we go in, a lot of the time we say, well, if we pay off that debt, we pay off the car loan that's $450 a month and might have 10 grand left on it because maybe it's only got 2 years left, let's say, and we're going to pay off the line of credit. We pay those two things off. We added 30 grand to the mortgage, and now we've increased 200 grand of borrowing power on the other side. So we've created net 170 grand of purchasing power out of thin air. So
Mm.
there are little things like that. And the consolidation side, car loans is, one of the big ones. I'm looking at you guys out in Alberta with your big F-350s and everything.
They do have big trucks there.
Yeah, they do. They do. And I get it. The snow, I know, I understand. But also, just because your coworker has an F-150 doesn't mean you have to get an F-350, right? So
Yeah.
that truck payment of $1,000 a month, like it may be the difference between you qualifying or not, and you may have to make a choice. And I've had conversations with clients before on you're going to have to pick the truck or a house. It's
Mm.
one or the other, but it can't be both.
Yep, very good. So everybody pay attention, okay? Leave the 350 at home. Or sorry, don't take the 350 at home. Do something else with that, right? So okay, so we talked about the qualification side. For a lot of people they'll get started, they'll buy their first property. I know this happened to me. Bought my first property, overcome a lot of the fear factor that comes along with this. And I've shared this a lot on this podcast. I was shaking in my boots, signing my line of credit, so scared. And then when everything kind of just balanced itself out and it was like, oh, that wasn't such a big deal. And now all of a sudden the kind of the addiction kicks in. And I'm sure you've had the same thing is when you get into real estate investing, it's exciting, it's fun. And when you start, and if you've done it well and it's generating cash flow, you're like, yeah, this is great. Now I want to do the next one. And then you hopefully get qualified for the second one. And maybe you're lucky for the third one. And then maybe the banks say, Mr. Ponte, you're done at number 3 or number 4, number 5. Um, is there a reason why the banks are stopping? Is it just debt service, or are they also put limitations to how many mortgages you have? And then the second part to that question, Kyle, is how do we overcome that? Is if we're hungry and we're wanting to do this, how do we overcome that so we can do more than 3 or 4 properties?
Yeah, so a lot of lenders do have a cap or limit on the number of properties that you can own. This cap is often, not always, but often, it's 5 properties in total,
Mm.
or 5 with them. And so that's often what you're going to run into and face. And the ones that are 5 with them in total, some of these still have a cap of maybe 10 throughout the entire portfolio, as long as no more than 5 are with that bank. So it is tough. Like, we have had some clients that have 13, 14 properties, and 1 or 2 banks will still consider it. But it has to be a really strong borrower. And what happens in that case is there's a lot of pressure from the government, and from risk management on the banking side, to say, this is no longer a residential mortgage. This is you are an investor, you are running a business. These needs to be evaluated by somebody that can more appropriately evaluate your business risk as a borrower. Because if you can't run this like a business, then this whole house of cards could fall apart, right? So they start to say this is more of a business loan. And so, generally speaking, business loans, you can get those. We call them commercial lending on the mortgage side. But they're going to look at it through a different lens, and the underwriting and qualifications is different in that circumstance. They're leaning more on the overall income of the portfolio. They start to look at your ability to manage this, and all of a sudden, the fact that you've done this 10 times is actually a pro, not a con on the commercial side. Interesting. But they look at things through a very different lens. But I think because residential lending is so black and white, cut and dry, there is no real evaluation of whether this person can run this kind of business. And so I think that they really start to push it and say, you know what, we really need somebody on the business lending side to evaluate you as a business owner and your ability to run this like a business, to ensure that we would continue to lend to you. So people eventually hit a cap or limit. And I find the natural progression for many investors is, once you're at 5 or 10 residential properties, a lot of the time you realize, okay, that was fun. It was good. I was able to leverage a lot and build the portfolio quickly. But now I'm realizing that I got 10 different mortgages, and they're all coming up for renewal at different times. I've got properties in different areas. I've got property manager here, property manager there. I've got 10 different property tax notices I've got to handle, all that kind of stuff. And eventually people think, well, maybe I should consolidate and just do one apartment building, because you get the economies of scale and do that. So it's a really common transition for people to move into that. And that's a commercial loan anyways. But it becomes more efficient for your time, because there does become a transition where eventually you realize, well, it's still return on not only investment, but return on your time. And it does become more time to manage all of those residential properties, all of those mortgages, all of those items. Whereas if you just have one apartment building, one property manager, one person to contact, it becomes a little bit easier on your time.
Yeah, it makes total sense. Yeah, that's great stuff. And I agree with you, because that's kind of the normal pattern for most investors. I've been doing this for 24 years. I got started, loaded up on a bunch of single family homes till the banks actually stopped saying, Mike, you're done. And it wasn't even debt service. It was exactly that. The banks just said limitations. And then to your point is, you'll still be able to get a few here and there from other different financial institutions. But at the same time, this is why you work with a mortgage broker versus just a conventional bank, because they will limit you based on that facility. But there are other alternative options. And at the end of the day, it's just still got to make sense. But then you move over to something like commercial or multifamily types of properties, because again, you're continuing to learn and want to scale. So let's talk about some of the things we need. Like, so to qualify for a mortgage, especially like, if we're getting to 2 or 3, how do we be best prepared for you, Kyle? Because I don't think that's something that is normally talked about, is let's help Kyle get that approval, that yes. So what can we do as investors to be better in regards to preparation to make your job a little bit easier?
First of all, it's best to do the pre-approval process. And pre-approvals on rental properties is kind of tough. So when you're buying your first home or your own home, a pre-approval is pretty straightforward because it's just in the inputs and outputs are really clear. It's just what is your income and then what do you want to buy and this is how much you qualify for. When you're buying a rental property, sometimes it's difficult because we say, well, you can go all the way up to this number, but then we have to use one or two lenders that use a really high percentage of rental income, and here's the kind of rate you're looking at. If you go in this kind of range, it's probably going to be the lenders that use the mid-level amount of rental income. If you go in this level and this range, then you can qualify with anybody. But you're at each of those, you're making two assumptions, not one, which makes it harder because you have to say an assumption on the purchase price, but also on the expected rent. So pre-approval is tougher, but at least it gives you an idea of what the range is and what ideal circumstances may be. Because then you say, well, yeah, you know what? I know that if I go up to the high amount, I know I might be paying a bit more on the rate, but I just really want that type of property. You might be more cost conscious and you say, you know what? I don't need to go up that high. I'm going to focus on stuff that's here. But an important thing is you want to be able to run the numbers because maybe the property is more expensive, purchase price range and even interest rate range wise may still generate a higher rate of return for you. And so that's where I know there's savvy tools. We have a spreadsheet internally too that maps out what the cash flow will be, the return on investment. And so you can literally map out and compare property A versus B at different price points, at different rent amounts, with different mortgage rates even, and see which one makes the most sense. But long story short, it's important to have an idea of what's possible because if you want to go in prepared and go in aggressive, especially as an investor, you're looking at this and not thinking, oh, I want to move in and the walk-in closet needs to be appropriate for my wife's shoe collection or whatever it is. You're looking at it more objectively in the numbers, and I need to get this price on it to make the numbers work. Yeah. Well, one of the ways of being able to negotiate on price is to be able to have everything else be flexible in the terms, right? So you can give a lower price if maybe the seller is motivated, has to sell in 30 days, and you're like, I can move that quickly. I can get my subjects off in 3 or 5 business days because I have my pre-approval ready to go. I'm ready to rock, where if you're writing the offer and then calling the mortgage broker, now you're behind the 8 ball. You might get to a point where by the time that you have your finances and have a pretty good understanding of whether you qualify or not, but you need a bit more time. Maybe there's another offer that's higher and they won't give you an extension, and all these other things can come up. So it's important to be, getting active early in advance. And the thing that helps us too is it's garbage in, garbage out is the terminology used in this kind of stuff. And not to say it, I don't like the word garbage, but the reason that they say that is the more information that you can give ourselves or the mortgage broker you're working with of where you want to be in 10 years, the better the outputs will come from the broker too. Because if somebody says, I want to own 10 properties in 10 years, Kyle, how do I make that work? Okay, that's a very different game plan than somebody that says, I'm just going to buy one and I want the best rate on that. Very different game plans, and that's the conversation we have every day with people, is trying to have that foresight of like, I think this best aligns with your game plan, because if you want this, then you should structure it that way.
Yeah, I agree. Like, I think that's it. It's really hard. And especially for people who are just getting started, they may not know what the heck the roadmap is. They're just like, and that was me many years ago. I'm just like, I'm just going to buy my first investment property. And I was losing $40 a month, which wasn't a big deal back then. And again, then the addiction kicks in a little bit. And you're like, okay, I'm going to buy my second one, my third one. And then all of a sudden you're just like, yeah, I think I want to own like 100, whatever. But then you got to kind of deal with all the obstacles that tend to come along with this business. And that's what they are. There's always a ways around it. But again, this is why you need to start to kind of, the more clarity you have at the very beginning, the easier it's going to be for you, and the easier it is for your team to help kind of help you accomplish the objectives that you're striving for. So,
yeah.
Let's talk about residential. Now, we talked a little bit about residential, but and we did talk a little bit about multifamily a little bit. And it's just like, so, multifamily is a little bit different than residential. So maybe we can talk a little bit about that. What is the difference between residential and multifamily? And to be very clear, multifamily is 5 units or more. And I think there's even some company or some facilities, they'll take 6 units or less. So I'm not sure if I heard RBC doing that, or I'm not sure if that was true. Yeah.
RBC can go up to in certain cases.
Yeah. So maybe what's the difference between the two, from a residential to multifamily? For anybody that may be looking to get in, they're still maybe wearing the hat from a residential investor versus a multifamily, but it is a little bit different. And the way it's kind of underwritten is a little bit different. So maybe you can give us some direction on there.
Yeah, I mean, I'd actually argue fundamentally it's very different because a lot of people can be shocked with the difference in underwriting. A lot of people, when it's their first foray into commercial lending,
Yeah.
which the easiest way to think about what's commercial and what's residential, it's effectively 4 units residential and less is residential. Everything else is commercial. And yes, there's that little minor exception range of 5 or 6 units. A couple of lenders will service the 5 or 6 units on the residential scale, but you have to dive into. There's a couple of questions and a couple of things they need to clarify with regards to zoning and whether that's a permitted use or not. So there's a couple of things that they look at. But long story short, generally speaking, 4 or less residential is residential. Everything else is commercial. So 5 or 6 or 10 or 20, or an industrial park, or a strata office space, or anything like that would be considered a commercial loan. And then with the commercial loans, there's 2 different classifications and ways of looking at it. So one is owner occupied. So just like you buying your own owner occupied condo and you're having your personal income to service that, with a business, you can get a business loan to purchase an owner occupied space, and then they can give you financing based on the income of the company itself that's going to be an occupant. And so that's a bit of a different structure, and you have different options, frankly, much better options in general than most of the other investment opportunities. Some banks don't even really have much of an appetite for commercial investing for investment right now, and they're more focused on the owner occupied side. You
Right.
can actually get all the way up to 100% financing for owner occupied space, especially if you're in certain businesses. Like healthcare in particular is one of the ones where people are rolling over left, right, and center for doctors, dentists, and anybody that's in the healthcare industry, because it's very repeatable income. There's not really a lot of market risks to those types of businesses, so very good terms. And a lot of the banks will compete very heavily for that type of business. If you're looking at an investment, then they're still looking at the performance, but now instead of the company that's residing in it, it will be effectively the financials of the actual property itself. And so they're looking for usually a debt coverage ratio of about 1.2 to 1.25. And what that means is that, let's say that you had a property that generated $12,500 in monthly income. And let's say that the non-mortgage expenses added up to be about $4,000 a month. They'd want to grant a mortgage no more than about $6,000 a month, because $6,000 a month mortgage plus $4,000 non-mortgage expenses, that's 10 grand a month in expenses associated with the property on 12,500 of income. That's a 1.25 to 1 ratio of income to debt. So that's effectively what they're looking for. So you reverse engineer the maximum loan amount based off of the property. So you do not get pre-approved for anything really in commercial, especially on the investment side, because every deal is what determines the maximum loan amount.
Right.
So we do have a spreadsheet for that, because I love spreadsheets.
I know you do.
That too, where you can pop in the rents and all the expenses. And it's a bit harder if this is your first time, because you might not know what to put in, or a pro forma provided by seller might not be quite indicative of all the expenses. They always forget something. It's like, hey, I noticed the property is in Alberta, basically anywhere in Alberta, and there's no snow removal cost included in the pro forma, right? Or other things like that, where it's like there's going to be some expenses here that have been missed. But long story short, you can still, even as a newer person, you can still fill in the fields, and it will give you an idea of how much financing may be achievable. Now, here's the issue with this. Usually when people start getting into commercial lending, the amount of financing that you get is usually way lower than you expect. It does depend on where you're looking, but if you're looking in like Greater Vancouver, as an example, the rents versus the prices are way out of whack. The income that you generate is really low. Industrial properties and multifamily properties in like West Vancouver, or I should say Vancouver West to be more specific, or Kitsilano kind of area for those that know. Often the amount of financing that those can service is only 25% of the value of the asset. Yeah.
Serious. Wow. That's insane. Wow. And that's just because the ratios are so off, rent to income, the rental rate based on the valuation. Wow. That's unbelievable. I didn't even think it was that low. Wow.
Yeah, in many cases it's that low. And the reality is, because what people are paying for in those cases, it's not for the income, it's for the expected appreciation of the asset. So it's always a matter of, okay, if I think that market and that type of asset will appreciate a lot more, they're willing to pay a higher price compared to the income because the income is not where they're expecting the returns. The expected return is from the redevelopment of that asset. So an older apartment building that eventually could get torn down, rebuilt into condos, into a tower, well, you're kind of just paying for the land, the underlying asset. And here's a very interesting thing that I say to people all the time to kind of help understand this is land appreciates and buildings depreciate. So that's why people like to buy detached properties, etc. Right? However, building is really what produces cash flow. Land does not produce cash flow. So if you just zoom out and you look at, okay, I want to buy this investment, you have to think about like, what are you paying for? Because if you're paying for land, you probably will expect more appreciation, but lower cash flow. And if you're buying something that has a lot of building on it, then you're probably gonna have more cash flow and less appreciation. And so then you have to kind of look at like, well, what is your expected return by investing in those different assets? Like if you have two houses side by side, and one of them is literally 2 units, and each of them it's a duplex and it's 2,000 square feet per side, you probably get about double the rent or close to it versus the house next to it that's just half and it's only 2,000 square feet. But if you had two houses side by side where one of them has a lot that's twice as big, you probably won't generate a lot more income for that land if it's the same house size. Somebody's probably not going to pay twice as much for that to rent that property because, oh, my dog can run around a little bit more in this yard than the other one.
Makes sense. That makes sense. Awesome. Really great stuff. And like, I was actually a little shocked what you just said about 25% because I actually didn't know it was that low in the Vancouver market, which both Kyle and I are based here in the Lower Mainland here in Vancouver. And so when you see some of the commercial financing that we're doing in some of these other markets, that's some of the lowest I've ever seen. But I know that the different prices, like based on what you just said, I didn't think it was to that level, but shocking. So that's crazy.
Very low. Yeah. And also too in BC, there's rent controls and a lot of those properties have tenants that have been there for 20 years. Yeah. And so there's also what we call a normalization of income and expenses, right? Like, well, if you could get rid of these tenants, then you could charge market rates, right? And you could get this. And so a lot of the time you'll see a pro forma where it's like, this is the current, but this is the normalized income and expenses or projected, right? And of course it's like, well, sure, but how am I going to get rid of those tenants? And
exactly. Yeah, that's exactly it. There'll be lifetime rent. And you know what? It's so funny. I've in being part of Savvy Investor and talking to a lot of investors, how many people I've actually said is I am not planning on ever owning a home because my rent is just so low, and they're based here in Vancouver. But I will, all the money that I've been making, instead of buying my own personal residence, they're buying it for investment properties because if they go to a mortgage, it's so much higher. So I've heard a lot of that too, right?
Yeah. Yeah, depending on where you live, right? So
yeah, for sure. So let me ask you, and I think just maybe elaborate a little bit more, and I think you just talked about this, but when it comes to the personal finances versus the building financials, what's more important? Because there's always this misconception, and is that, hey, by going into multifamily, I'm not necessarily qualifying for the mortgage, which is partially true, but partially not true either, because there's still some element, as you mentioned a little bit earlier, but there's this misconception that the building is fully qualifying. So is it 100% true that it's the building's qualification, or is my personal finances also impacted and needed to be taken into consideration in this as well?
Yeah, personal finances is brought in. It's just that's not the black and white of what makes the decision. You always start off with what does the property service, and what's the black and white of how much debt I can get on that, and then they're going to roll into, okay, now does it make sense to lend to this borrower? Is their personal debt servicing out of whack? And this is where mitigation comes into play, because maybe they do have a very large mortgage compared to their income on paper, but maybe they're an investor and they have $10 million of liquid investments on the other side. And so they say, man, you know what, that's okay. As a general rule of thumb, you usually want to be looking at about 10 to 20% of the loan amount that you're seeking should be in additional liquid assets on the other side for commercial lending. So they do start to look at that a little bit more. Even in residential lending, we do see that they will come back, and this is where it's more gray area in residential, but they're going to start to say there's not a lot of liquid fallback here. And some different metrics and different ways of looking at it. Sometimes it's a flat amount per property of about 30 to 50 grand per property. Sometimes it's, hey, if you have more properties than this and they meet certain criteria, then you need $250,000 or even $500,000 of liquid assets. But the liquid assets does become relevant. And so a lot of investors, they come to Savvy and they're like, okay, I'm going to do all real estate, but
Yeah.
it only works to a certain point. Maybe you can do 1, 2, 3 properties, but you do have to have some liquid fallback. And frankly, this is where we talked a little bit about running a business.
Yeah.
Well, you can't run a business with zero liquid fallback, right? And that's
Yeah.
where it's really important to have some cash in other investments that de-risk you, especially if your portfolio needs some, cash injection.
Yeah, or even just changes in market. We've seen it a lot of that. Is you definitely don't want to be over leveraged by any means, and secondly, you always have your reserves. You treat it like a business, 100%. And I think for anybody that's just getting started, don't do that. Don't over leverage yourself, and because it puts you in an awkward position. Obviously, qualification side changes things a lot, but I've seen so many people get themselves in such awkward positions just because they went literally all in. So just be very, very mindful of that.
Yeah.
Yeah. So when it comes to underwriting, when it comes to multifamily, what are the banks looking for? Obviously the individual, the property itself, but when you reference 25% in Vancouver, what's determining 25%, 35%? Is it, obviously the property's performance is one thing. Is there any other elements that the banks are being very mindful of? Because I know, again, this is technically a business. So what other things are they paying attention to when it comes to getting this underwritten?
Yep. So they're going to be going through the financials supplied by the seller. And this can sometimes be a challenge. And I find this is more of an issue in smaller towns, as an example, where, or just more lackadaisical management of the existing asset, where sometimes somebody writes an offer on a property and we say, okay, here's all the stuff we need. And then the buyer comes back and says, the seller doesn't have it. Like, well, what do you mean they don't have it? They have to have their taxes filed somewhere, but maybe the seller doesn't have their taxes up to date. And all of a sudden, there's no financial information or data to back up any of the information. The banks need to verify all of the income and liabilities associated with that property. So that means looking at the lease agreements, reviewing all of those, reviewing the property management agreement to see what's the property management cost, reviewing the property taxes. This if it's a strata property where you're buying properties that are currently strata titled, what the strata fees are. What the average maintenance has been, and usually they're going to use some minimum number on the maintenance side, or of course, if the maintenance has been higher, then they want to use the higher number. We talked a little bit like garbage removal, snow removal. There's all these different expenses, and then you start to get into like larger multifamily properties, and you start to get into like caretakers and other expenses that can be associated with the property too. So there's a lot of things that they look at there, and they're determining what the income and what the expenses are to determine the maximum loan amount. So there's quite a few things that you'd have to go through. And as again, a new investor, it's a lot to learn when you jump in. If you just started, you haven't done a few residential properties first and you want to do commercial and right away, there's a foundation there that you don't quite have. But even if you've done a few residentials and you go into commercial, it's still very new. It's a totally different world. There's a lot more to review, and you have to be very prepared for a lot more due diligence, a lot more costs. The lenders charge fees, brokers charge fees, appraisals are way more expensive. Minimum $1,500, but a lot of the time they're $3,000 to even $10,000. You need environmental studies in many cases, especially depending on where the property is, because the environmental risk is very concerning for lenders. There's so many different things that you could easily spend $10,000 on a property and then it still doesn't go through. And then you're like, well, that was a lot of money for me to have paid for no outcome.
Yeah, exactly. And I think that's the thing. You take the time to learn, guys. And, Kyle nailed it on the head. And I say this all the time. When you're investing in single family, obviously learn that strategy. Try to be, learn as much as you possibly can, and wear your residential real estate investing hat. Put that on, because all the things you've learned for that. When you're doing multifamily, you need to take that residential, all that knowledge and stuff from residential, throw it in the garbage and put your multifamily hat on, because they do have significant variances in regards to how they're analyzed, how they're financed. It's all these different things. Like even just for an example, just for everybody's, Kyle just brought it up, all these different costs. What about timelines, Kyle? Like to get a residential approval versus multifamily, what are you seeing for timelines with that situation?
Yeah, I mean, residential is usually closer to a week, sometimes 2 weeks in smaller markets. A week if you use a Vancouver broker, because we're pretty typically getting a week for normal stuff on Vancouver Island or in Alberta. Like, wow, 2 weeks, awesome! We have so much time. And unfortunately, the lenders, of course, go, okay, great, we're going to stretch into all that. It still gets done the day of subject removal, which is really frustrating. But that's just the way it is. But usually 1 to 2 weeks to get the financing in order, and then you can close. generally speaking, another minimum 2 weeks, but usually 3, 4+ weeks after that. So front to back on residential, you can do in and out in 30 days to 60 days.
Yep.
Commercial, it's 30 to 60 days just to do the due diligence part. So much longer process. A trick that I like to ensure that is included in any contract is that when you write the offer and you say, here are all the things that I need, my due diligence, and usually your realtor or a lawyer, if they're the ones writing up the contract, will tell you the stuff that you should be putting in there for your subjects or conditions.
Yep.
Try to make sure that the clock doesn't tick on your timeline until they've provided all of those documents. I've made that mistake before. Other clients of mine have made that mistake before. And all of a sudden, the due diligence stuff is coming in a week or two beforehand. You're like, okay, and now I've decided that it does make sense. I'm going to pay for an appraisal. That doesn't come in until after. And there's now a backup offer in place that's higher than yours. And now you're like, I've spent money, I've spent time on this, and now I'm getting kicked out because the seller took too long to get me the stuff. So make sure that subject time period doesn't click in and the clock doesn't tick until you receive all of the due diligence documents. That's a pro tip.
Yeah. And again, that's it. You know, for those that are listening to this, like what due diligence documents, that's technically an episode in itself, really, to be honest with you. Multifamily is just very, very different. And I think the important part is, if you're going to go down this road, understand it. And it's kind of crazy. And I'm sure you maybe have seen this too, Kyle, is back during the COVID days, we saw, you know, everybody was flush with cash. They had lots of money from the government and all these things, and they're just jumping into multifamily lock, stock, and barrel. But a lot of people just really didn't have that knowledge. And I know that for some of them, there was some pain points there because they just didn't learn. They just didn't know how that strategy worked. They've overpaid. They didn't do proper due diligence. So, you know, that's a big tip of advice. You know, what Kyle's just referencing here is due diligence documents, and don't let the clock start, meaning your conditions start until you've received all that. It is so true, because you know what, 45, 60 days, it sounds like a long time to close. In commercial, boy, does it go fast.
It does.
Really, really fast.
Yeah. An appraisal takes 2 to 4 weeks easily. 2 is actually really fast. And if it's a smaller town where there's travel involved and whatnot, the closest appraiser might be hours away. And then they're going to say, well, I'm going to go there when I have another report to do so I can at least get 2 done at the same time. Or I'm going to charge you all of the travel time back and forth. You're like, oh my God, this appraisal is costing $7,000 because it's in the middle of nowhere. Or I could wait a little bit longer and it's only going to be $4,000, but now I have to wait until the appraiser has another report to do in that area. Like, there's just so many little moving parts that make it trickier.
Yeah, for sure. You know what? It's kind of funny. For a lot of people who are listening to this episode, your mind must be kind of getting blown. It's just like there's just so many different things we've just discussed and a lot to unpack. And especially for the new investor that's listening to this, and you're just like, okay, we talked about Smith maneuver, DCR, you know, restructuring or amortization, constant changes on the market, multifamily versus residential, and banks putting limit. It's just like, oh my goodness, your head's kind of spinning. But to be really clear, you guys don't need to all know this. That's what Kyle's job is. That's why he's the smart person in the room, to be very honest with you. And so, you know, he mentioned this a little bit earlier, is designing kind of a roadmap of some clarity. And this is not just from an acquisition perspective for somebody that's buying their first investment property. I highly encourage a lot of people that may own already 4 or 5 or 6 properties. When was the last time you really reassessed your roadmap and just reviewed it and looked at some of the other opportunities of potential refinance? Because you might have to be sitting on a ton of capital that you can repurpose back for other investment properties, and just really reassess. And that's something Kyle does. And you know, correct me, Kyle, that you do create kind of like roadmaps for people to help them.
Yeah, exactly. So we look at a 10-year game plan. 10 years is usually the length of time. And what we do is we basically look at where you're at now, pop in all of those assets and the expected returns from all those assets today. And then every year, that extra cash flow from events like cash flow from rental properties, personal extra cash flow investing into assets, and all of this. And then you spill that into, okay, now after year one, you have 50 grand extra. And then you pick where are you investing that for the next year, and it kind of keeps spilling over and spilling over. And the idea is to try to reverse engineer this and begin with the end in mind, which is, what is your objective? Are you trying to replace your income in 10 years so you can retire? Are you trying to build as much wealth as possible in 10 years? What is the objective? And then we try to work backwards and create a plan that can execute on that. And it's really cool because there's so many different investment and asset classes you can invest into at different timelines and different investment performance. Like how you make money buying real estate versus being a lender is very different, right? And so mapping that all out and making sure the game plan is custom designed for each individual, it kind of helps give a little of clarity, and especially for new investors or people that just don't know what to do next, it adds a lot more clarity.
Yeah, I think that's great. Like, that's one thing I loved about, about Kyle and his team is that's exactly what they do is they've taken the time to kind of, really build that plan for the next 10 years. In some cases, you may not even know. But that's where the questions are being asked of you. But the more information that you can provide or get, the more clarity you can have in this, it really, again, it designs that roadmap for yourself. So why not have somebody that's kind of helping you coach you through that entire process step by step, and at the same time just making sure that your assets and your portfolio is always performing well, and if not, how do we pivot, how do we change this, but having some of that clarity. And in a lot of cases, I look at this, you look at a financial advisor in a lot of cases for your own retirement and stuff. This is yet another option when it comes to your real estate investing portfolio. So if you haven't had kind of an assessment and you don't necessarily know what you don't know, definitely reach out to Kyle. I think that's one of the great services that you provide, Kyle. So thanks for doing that. And thanks for supporting our community. I always ask this, and I've asked this before with you. And so maybe the answer is going to be a little bit different since the last time I asked you, but, final words of wisdom for new real estate investors that they are just starting, just beginning, or for those of you that are, maybe at a position that they're capped at 3 or 4 properties. What would you suggest, or what would you recommend for them?
There's almost always a path forward in all circumstances. There's always little new nuances and new doors that open up and other ones that close. And so I think if somebody has been told no and that they've been capped out or whatever, just because one person or one bank told you no doesn't mean that another door isn't available through different means. A lot of the time, it's just a matter of restructuring things. And sometimes the restructuring is too expensive. Sometimes we look at it and say, you know what? We need to restructure this mortgage and re-amortize it, but you still have a 5-year fixed rate from 4.5 years ago or 4 years ago at 1.89. We're not going to touch that one right now. We're going to wait until the renewal comes up, and then we're going to restructure it. But there's almost always a plan to restructure things and then have something that allows you to move forward. And sometimes the plan is, hey, you know what? You don't have any assets. You don't have anything to your name right now. You need to learn more about joint ventures, right? And you need to go through more of the savvy content on like how do you find investment, properties, and how do you find JV partners or whatever. But I think just having clarity moving forward is really key. It makes it a little bit easier to know, okay, I know what I can do, I know how to do it. There's almost always a way, and we're always sourcing new, different opportunities. Like as an example, we found a different channel through a financial planning arm of one of the big banks, and that there's 3 people in the whole country that have access to being able to finance people residentially for up to 40 doors through residential lending. And so all of a sudden it's like, how did I not know that this existed, right? But it's like there's literally like a small team, only like 3 guys in the whole country can do it because the bank doesn't trust that most of their mortgage team actually understands how to do this. And so all of a sudden it's a brand new door that's opened up for us that we are finding a large number of clients are getting financing for. So there's always new opportunities, and things change. If you've been told no before, even by my team, doesn't mean that it's still no, because things move and shift all the time. And sometimes it's a matter of sitting back, thinking about it, and creating a plan. And last thing I'll say to that is that a lot of investors have been sitting on the sidelines and just kind of waiting this out. I've had a lot more people come back and think, you know what, I think now is maybe the time, because it seems like rates are kind of settling into a part where they aren't going to go much lower than they are now. Valuations have been coming down, but especially depending on where you're looking, it's like, well, where is that going to be moving and shifting? And sometimes this is a great opportunity for investors to go in and say, hey, not a lot of buyers out right now, I'll buy it, but at this price. So I think investors are starting to come back in. So maybe now is a good time to think about it, think about what the plan would be if you wanted to start to take that next step forward and start to reinvest again, because a lot of people have been kind of waiting for a while, and maybe now is the time to look again.
I agree. And it's something we just talked about just even last night in our Savvy Squad community, actually, is exactly that topic. It's just like, you see, and there's going to be a lot of news this coming year. And this is my 2 cents, tariffs and impact and job loss and all of these things. And it's awful and unfortunate in a lot of cases. But as real estate investors, these are really some of the best opportunities in some cases. So, you've got low interest rates, you've got potentially motivated sellers, you've got a lot of inventory. It's not like the good old days where you had to go over asking price, no conditions. The world's really become your oyster. And it's just making sure that you are finding the right projects that make fundamental sense, and are still going to support you in your investment goals. And real estate investing is not a 1 year thing. It's a long-term investment. Take it 5, 10, 20 years in some cases. And over time, you'll just see that pay some really big dividends. So
Yeah.
Kyle, super awesome. Really great, great having you here and sharing. If people want to learn more about you, or even just set up a consultation about doing your kind of roadmap for people, especially if they want to really reassess their portfolio, or even just getting started, they just want to know, especially with everything we've discussed today, where's the best place to go?
Yeah, so that roadmap is through my real estate investing consulting company, and that's greenwealthcapital.ca. So it's a different entity, different business, and there's different products that are available for that entity. And then for the standard mortgage, that's through greenmortgageteam.ca. And so myself and my team are able to help with restructuring mortgages, etc. So depending on what service you're looking for, and you can reach out through either option, and of course we'll be able to direct you and say, oh, that's for this side, or that's for that side. And frankly, these programs kind of work in hand, because a lot of time the game plan then presents, hey, you should refinance this property and restructure that, right? So you kind of pass the ball back and forth a bit.
Love that. And like we do for all of our guests, just go to the show notes, regardless if you're watching this on YouTube or your favorite podcast platform. We'll make sure all of his contact information, as well as the 2 different websites that he just referenced here, will be in those show notes below. Okay. So Kyle, thanks again. Really appreciate you having you. We'll look forward to having you in the future as well.
Thanks, Michael.
Cheers. The views and advice expressed on this podcast episode are solely those of the individuals participating and do not necessarily reflect the opinions or beliefs of the podcast host, its producers, or affiliated parties. All content shared is for entertainment purposes only and should not be considered as professional, financial, legal, or investment advice. Listeners and viewers are strongly encouraged to conduct their own research and consult with qualified professionals such as financial advisors, lawyers, and accountants before making any financial decisions or investments based on the information provided in this podcast or any related content. The podcast host and producers disclaim any responsibility for any actions taken by listeners as a result of information presented in this episode. Viewer and listener discretion is advised.